Good morning, participants. Welcome to today's webinar on the updates on Union Budget for FY26. The budget presented by Honorable Finance Minister Ms. Nirmala Sitharaman on Saturday continued on the path of fiscal consolidation. The tax relief provided to the individual investors may give a fillip to the slowing economy and boost consumption. I am Sonal Mittal, product specialist at UTI Mutual Fund, and I'm joined by our senior fixed income fund manager, Mr. Sudhir Agarwal, and head of equity research, Mr. Parag Chavan, who will be sharing their key insights and perspectives on the budget, providing us with a well-rounded understanding and potential impact of the budget on various sectors and economy. Please feel free to engage actively, ask questions, and make the most of this opportunity. Without further delay, I will invite Mr. Sudhir Agarwal to begin the discussion with his insights. Thank you, and let's have the session started.
Thank you, Sonal, and good morning, everyone. So I'll be starting with the fixed income perspective, followed by Parag, who will be joining me, in explaining the impact on the equity market. So starting with the fixed income, and then within that, I'll say the first part of the presentation will be focusing more onto the broad announcement in the budget, the gross, overall numbers announced there on the revenue and expenditure side, and followed by, the impact of, all those numbers on the overall debt market. How do we expect the debt market to move going forward after this, announcement of the budget? So starting with the key numbers, I'll say broadly, if you look at in terms of the revenue assumptions, the gross tax revenue, they have assumed to increase by, 10.8%, and the net tax revenue, they have assumed to increase by 11%. So that's in comparison to the overall 10.1% kind of a GDP growth assumed for this year. So I'll say a tax buoyancy of close to roughly 1 or maybe 1.1. So that's, I'll say, quite a reasonable assumption. Now, I'll, get further deeper into these revenue assumptions in the further slide. On the expenditure side, the overall, they have assumed an expenditure growth of 7.4% in this budget versus, the last year's number being close to, say, 5-6 handle. Within this, the revenue expenditure growth is assumed at a slightly lower number compared to the capex, which continues to grow at higher number, just like previous years. The overall, if you recall, in the last budget, government has promised that the next year, the fiscal deficit is slated to go below 4.5%. So they have kept their promise and then announced a fiscal deficit of 4.4%. Versus this year's 4.8% realized one versus, when they announced last year, it was 4.9%. So overall, government continues on to the fiscal consolidation path. And they intend to further lower our debt to GDP ratio by another 6-7% over next, say, 4-5 fiscal years. So, credible fiscal, I'll say, overall roadmap provided by the government. On the borrowing side, which is what impacts the market more, we have seen the overall gross borrowing increasing by roughly 81,000 crore, which was slightly higher than market expectation. I'll come to that later, in my later part of the presentation. And the net borrowing, they have kept it roughly unchanged at, say, hardly 9,000 crore lower versus last year. And on the T-bill side, they have assumed zero borrowing. Can we go to the next slide? Yeah, so these are the, I'll say, broad assumptions on the revenue front. As I just mentioned, the tax buoyancy, they have assumed the overall gross tax revenue have been assumed to grow at 10.8%, which is in line with the last year. What is, I'll say, worth noticing here is the income tax, wherein last year they have achieved a 20% kind of tax growth compared to the budgeted number being much lower, which was at 12.57 trillion versus, they actually, the revised estimate shows 14, compared to the budget 11.87, the revised number shows 12.57. But this is despite the fact that they have chosen to provide relief to people earning up to 12 lakh, in form of nil tax for them. So, if you adjust for that, the overall growth in the income tax, if you adjust for that 1 trillion worth of tax cut, the actual assumed growth comes to upward of 20%. So, which to us looks a bit more aggressive considering that the economy, has been slowing off late. So assuming a income tax growth of a number which is higher than that of last year, adjusted for the tax cut, is slightly on higher side, but we think they have enough levers on the expenditure front to offset this. The other numbers like, GST and all have been in line with expectation. Overall, the net tax revenue growth has been assumed at 11 odd percent, which is marginally on the higher side compared to, our estimate, but we think still they have enough levers to cover. On the non-tax revenue front, they have assumed a dividend from RBI, which is marginally higher than what it was last year. So overall, I'll say the number have been credible. Uh, if we look at the overall receipt side, the total receipt they are expecting, will go up by 7.4% versus 6.1% realized last year. Can we go to next? On the expenditure side, again, if you look at the expenditure growth for the next fiscal is assumed at say 7.4% versus close to almost 6% expenditure growth last year. Within that, the composition is such wherein, as I just mentioned, the overall capex growth, they have assumed at slightly higher number compared to last year. They have been able to grow their capex by 7%. This year, they have assumed at say 10%. I said that's also impacted by the fact that government is facing limitations in terms of how much more can they grow their capex. So, broadly, if you look at post-COVID, we have seen capex almost doubling as a percentage of GDP over last say 4, 5, 6 years. And it now continues to consolidate at 3% plus kind of a level. So while there is a slight slowdown versus the actual budgeted estimate last year, which was at 3.4%, but they have assumed it to be 3.1% for next year, which looks like quite realistic compared to previous year, wherein they failed to achieve that kind of a capex growth number, considering that first quarter of last fiscal due to election they were not able to spend the money. So this year's capex growth seems quite reasonable, and we do believe that there are high chances that they might be able to meet its capex target for this year. Now, the point I'm trying to, drive here is that if you look at there has been a serious fiscal consolidation over last 4, 5 years. So compared to 9.2% in the COVID year, from there, we have seen consistent consolidation and a meaningful consolidation happening, and has now come at 4.4%. So I'll say overall this goes very well with the market, because now the market can assume that the government is really serious about the bringing the fiscal deficit lower. From here, while they have not given any roadmap in terms of what will be the fiscal deficit year on year going forward, but they intend to now from here improve upon the overall debt to GDP ratio, and which will ensure that the overall fiscal discipline continues going forward as well. Yeah, so on the now coming to the borrowing front, which is what impacts the market in near term, while the gross borrowing compared to 14 odd trillion last year, this year it has increased to 14.82 trillion. But I'll say broadly, if you look at last 4 years, FY 23, 24, 25, and 26, the gross borrowing has been almost consistent in the 14 to 15 trillion kind of a range. So that's despite, I'll say, the overall demand increasing, driven by the FPI, increase in the long-only investors' book size and all, we have been seeing the overall gross market borrowing stabilizing at an absolute level of 14 to 15 trillion, which is, I'll say, very positive from the demand supply perspective, considering that the demand continues to grow at a fixed annual pace, while there has not been any increase in the supply over last 4 fiscal years. So this is what is giving a lot of confidence to the market. And if you look at broadly in the market, the fall in the yield over last a couple of years has been coming from this positive demand supply scenario, wherein demand continues to grow while supply is static. On the net borrowing side, the last year they have budgeted at 11.63 trillion worth of net borrowing, but the actual net borrowing turned out to be lower at 10.75. And this is after adjusting for the buybacks they have done, because, the system has been running at negative liquidity. So to provide liquidity to the system, the government has bought back its G-Secs maturing over next, say, 2, 3 years, which has resulted into optically the overall net borrowing falling significantly. But adjusted for those buyback, I mean, if we exclude that buyback, the net borrowing is roughly flat at say 11.63, and versus that This year it is at 11.54, so roughly a flat number on the net borrowing front. I'll say from markets perspective, that's some bit of a disappointment in near term, because market has been believing that the overall net borrowing will go down to roughly around 11 odd trillion, and the gross borrowing will turn out to be somewhere between 13 to 14 trillion, because the assumptions were that the small saving will continue to be similar to where it has been over last couple of years, but the government chose to cut small saving to 3.4 trillion versus 4 trillion plus in the last few years. So this is what has resulted into slightly higher dependence on the overall net and gross borrowing for the market. And on the T-bill side, again, I'll say broadly the market, while believe that they will do a smaller 50,000 crore worth of T-bill borrowing, net T-bill borrowing, but they have assumed it to be zero. So it's a continuous second year wherein the T-bill borrowing, net T-bill addition to the market continues to be nil or negative. So apart from this, government has also announced a market switch of 2.5 trillion, wherein they will buy the short-end security and sell long-end security. So this compares with the 1.5 trillion for the last year. So this is slightly on the higher side, and which should kind of put a steepening bias on the curve, wherein they buy the short security and issue long security. So that's bit of a steepening from the market perspective. But again, we think it might still not be disruptive for the reason because previously it is seen that if at all the market is getting disrupted because of these switches, we do see the overall RBI and government being flexible on that front and reducing their overall switching requirement. Yeah, next. Yeah, so I'll say broadly now to summarize the impact on the fixed income market. I'll say overall, this is a credible budget, considering that they continue to stick to their promises of consolidating on the fiscal front, and that in line with that, they continues to at least meet the guidance which they have provided in the previous budget and printed the fiscal deficit further lower at 4.4% of the GDP. On the other hand, near-term negative, I'll say, is a slightly higher gross borrowing number, but we think it can be still offset by continued FPI demand and the meaningful liquidity infusion by the RBI through OMO buyback, which we think should take care of the long end of the curve meaningfully. So while at once the market is taking it slightly negatively, that the gross supply is slightly on higher side, but we think there is enough demand in the market to absorb that longer part of the curve, and hence should not have material impact on the market. Apart from this, I'll say this continuation of fiscal consolidation, in our opinion, should provide further comfort to the market and to the RBI, that the government is serious about the fiscal consolidation, and hence that opens up some space for the RBI to provide comfort on the monetary policy front at a time when fiscal they are consolidating. So with that, we expect roughly 50 to 75 basis point kind of rate cut over next, say, 6 to 9 months, starting as early as this week in the upcoming policy. And we think this is driven by the fact that the overall growth is slowing, and the inflation is also expected to move towards its medium-term target. And along with that, a fiscally responsible budget should provide space to the RBI to deliver a rate cut. Now, the impact of that on the market, I'll say we overall expect the curve to bull steepen. So when we say steepen, so what, that's driven by the fact that, or rather, I'll say we expect the short end of the curve to start moving lower in terms of the yields. And while long end also remains attractive, but the short end still has space to over deliver, considering 2, 3 factors. Number one, that the overall, whenever we see the rate cuts, the immediate impact of that passes on to the short end of the curve, while long end has already been pricing it for quite some time. Number two, the reliance on the short-term borrowing continues to be low. So for example, the T-bill borrowing continues to be nil or negative. So the net T-bill borrowing, so that will also ensure a steeper curve. And number three, slightly higher switch announced by the government should ensure that, the short end continues to find support in by way of, continuous purchase by the RBI in that segment, and that should ensure that, the curve continues to steepen. So broadly, I'll say this is 1, 2, 3, 4 year part of the curve which looks most attractive to us, especially on the AAA PSU or the, liquid PSU, liquid corporate bond part of the curve, wherein, when compared to a 10-year corporate, 1, 2, 3 year part of the curve is inverted, and that's where the accrual is attractive at a time when RBI is cutting rates or is expected to cut rates. So we expect this part of the curve to steepen going forward. So not only higher accrual for the investor, but as and when the rate cut happens, we expect impact of that to be most felt on this 1 to 4 year part of the curve, and hence, we continue to be constructive on this part of the curve. And now handing it over to Parag, so he will take you through the impact of the budget on the equity and different sectors.
Yeah. Hi, everyone. Thank you for joining in for this webinar by the UTI team. And thank you, Sudhir, for the wonderful explanation from the fixed income perspective. Now I'll take you through how the equity market or the different equity sectors are impacted by this presentation, by this budget. When we are looking at the broader themes, right? So on the next slide, these are the three broad things which we could highlight. And make no mistake, this was the budget which focused on the consumption in a big way. I mean, last many years, income tax slabs weren't changed substantially. The middle class didn't get a significant large benefit out of the tax reforms, but this was the year when we have seen a significant improvement from the middle class perspective. And with these changes in income tax slabs, the higher disposable income, we expect the consumption to get a significant boost. At the same time, the government has made sure that the fiscal consolidation continues. And with this lower tax revenue and also managing the capex, we haven't seen that the fiscal consolidation has gone awry, and the path remains. So government has indicated, as Sudhir has already said, the next year as well, 4.4% GDP is the basically target which we are having, which is continuing with whatever the earlier guidance they were giving. And at the same time, they are trying to revive the economic activity by doing small things to just simplify the process. So there are many deregulations or simplified tax structure or simplified duty structure, especially for MSMEs as well as in the agriculture sector, which we expect will spur the economic activity overall. So that's how we are looking at the business from the equity perspective. A major boost to the consumption is being provided, at the same time continuing with the fiscal consolidation, and there's an emphasis on deregulation as well as ease of doing business, which should spur the economic activity and the potential revival in economy. Going ahead, just focusing more on the income tax proposal, because as I said, this was the major change, a major surprise in this budget. As we can see, from last year to this year, we have seen a significant change in terms of both the tax rebate which you can get. So basically now till 12 lakhs of your income, annual income, you will have to pay no income tax. And that is a major change. Last year, this limit was till 7 lakhs. So from 7 lakhs to 12 lakhs annual income, you have got a significant boost. Also, because there are tax slab also which has changed, and incrementally, so for higher income as well, you are paying lower tax. So it's not that only for the income up to 12 lakhs you are getting benefit, even the higher income earning people are also getting benefit out of this tax rates. So effectively, about at that 24 lakh kind of income, you are going to save about 1 lakh rupee in your tax. That is the benefit which you are going to get. So across your income slab, income group, you are getting benefit because of these new income tax slabs, and that is going to give a lot of higher disposable income in the middle class family, and that should actually spur the consumption, boost the consumption in big way. So that was the major theme, or as I said, major surprise from the budget. And now I'm looking at how different sectors will actually get impacted with this budget. So on the next slide, with this tax slab changes, as I said, the major beneficiary will be all the consumption related sectors. First, just looking at FMCG, where basically again these income tax changes will boost household consumption of all the small ticket items as well as discretionary items. Uh, so that basically from lower end will increase your consumption, as well as the other sectors like consumer durables, which is more discretionary, even automobile, which is also more discretionary. There also you will see that this higher disposable income will lead to higher consumption. Specifically for FMCG, along with this higher income leading to higher demand or higher consumption, there was no change in tobacco taxation. That is also another positive for cigarette companies. Although there is a small negative that on the palm oil side, the custom duties were kept same. So there is a high palm oil cost currently, and that is impacting the companies. So we're expecting some kind of cuts there, but that hasn't happened. So the raw material cost will remain elevated for some of these companies, but this is a small negative in terms of overall large positive which you are getting because of the higher disposable income. When I look at consumer durable space, again, as I already mentioned, the higher disposable income will lead to higher demand, higher consumption of these items. Specifically on EMS, that is the electronics manufacturing services sector, we have seen much more specific regulations. So there were multiple basic custom duty changes. So on the flat panel displays, which is the final item which was getting imported, now the basic custom duty is hiked from 10% to 20%. That will basically result into lower imports of final item, as well as on the components or the parts to make these flat panel displays, we have seen lower BCD. So because of this, the open cell or the other smaller parts of LED, LCD TVs, as well as smaller parts of your mobile phones now are seeing lower basic custom duty, which will effectively mean that the domestic manufacturing of all these consumer discretionary items or the large white goods should go up, which is a big positive for EMS companies. Similarly, on the automobile, again, the main theme remains, but apart from that, on the EV side, we have seen some benefits which have come. So on the, again, custom duty side, 35 different capital goods for the lithium ion battery for the EVs, as well as lithium ion battery scrap and other critical minerals are now seeing lower or actually no custom duty on them, which will again boost the manufacturing of these EVs or these batteries in India. Also, there are other budgetary allocations for EV schemes as well as PLI schemes, which will also benefit in general manufacturing of EVs or the automobile in India. So that way, both from the demand side because of the higher disposable income, as well as because of this lower duty structure, as well as some budgetary allocations, we see automobile industry also to do well. So overall, the consumption space looks to be doing very good, getting benefit out of this budget in a big way. Next, when we look at on the infrastructure side, so infrastructure is kind of neutral because when government is trying to continue with its fiscal consolidation, the capex growth is kind of now little lower. Specifically, when you look at railway capex as well as road capex, it is kind of flattish from FY25 revised estimates to FY26. Only on the defense capex, we are still seeing growth. So defense capex is expected to increase by about 13%. Also, there are some other smaller missions. So Jal Jeevan mission and again housing and urban infra, where we are seeing good growth. Again, one point to mention here is that FY25 was kind of a lower capex year already, and because of that, we have seen from the FY25 budgeted estimates to revised estimates, there is a downturn. But from these revised estimates, now we are seeing good growth in some of these categories, like as I said, defense capex and Jal Jeevan mission, housing and urban infra. When we look at equity companies, this lower capex or the lower revised estimate of FY25 was kind of already getting factored in. So now FY25 RE is the new base, and we should be actually looking at how the growth is looking from this base itself, and which is looking good in some of these parts. Also on the building material side, so with this budgetary outlays to Jal Jeevan Mission and some of the irrigation schemes that going up, this is basically positive for plumbing pipe companies. Also, the allocation to PMAY is going up. That will result to more demand on the housing side, and with that, basically, this building materials is a ancillary for all the housing demand. So we expect that also to flow through to higher demand from the building material perspective. On the real estate side, again, the consumption demand, higher disposable income might lead to some higher demand. But another specific benefit was now the taxpayers are allowed to claim nil value for the two self-occupied properties as compared to earlier one. So earlier, you for second self-occupied property, there was a deemed rent which you have to show as your income. Now going ahead for the second property, that is not required. Earlier for the second property with some caveats or some restrictions you could have, but now it is those restrictions are removed and you can claim value for any of your second self-occupied property. Next, then generally all these both will tie up to how banking and NBFC will react, and we see this as a positive. There are multiple schemes, as I said, on the agriculture side or on the MSME side, which is spur the economic activity. There are specific schemes to improve the credit for these sectors, and that should actually lead to banking and NBFC sectors seeing a higher demand for credit. When we're looking at urban as well as the affordable housing, the PMAY allocation that has increased, that will lead to affordable housing loans, so that should be beneficial. Also on the MSME side, so specifically there are now credit cards, those will be issued with 5 lakh limit to 10 lakh micro enterprises. So this will basically lead to a higher credit demand. Also, now government is saying that there will be a collateral-free credit guarantee for the MSMEs. I mean, earlier the limit was 5 crore, but now that has been increased to 10 crore. So that will also lead to higher credit growth. On the agriculture side, on the agriculture credit, government has announced a credit limit increase for the Kisan credit cards. So earlier it was 3 lakh, now it has been increased to 5 lakh. So all these credit cards or the credit guarantee increases will lead to higher credit for the banking and NBFC. There is also higher IEBR allocation for HUDCO, which will basically result in the more financing options or more financing demand. On the insurance sector, though we have seen slight negative, so now the FDI limit has been increased to 100% from earlier 74%, which means the foreign insurers can directly enter Indian market without any domestic partner, which might result in a higher competition. But at the same time, we believe that the establishing distribution is an important advantage, important thing or important milestone. And foreign companies, foreign insurers will still take a longer time to do that. Until that time, the competition might not increase substantially just because of this FDI limit increase. So overall, a good budget even from banking and NBFC perspective as well. Next, looking at some of the other sectors. So as I said, agriculture was one of the main themes. There was focus on agriculture side. The agrochemical sector has also seen some good announcements. Government will take this Dhan Dhanya Krishi Yojana, which is expected to benefit 1.7 crore farmers in different ways. This will be on the higher credit side in terms of, in general, improving their ease of doing businesses and multiple schemes, taking benefit of those multiple schemes. Also, there were multiple announcements related to high-yielding seeds. So they are setting up a national mission to develop high-yielding seeds, doing some research about that. Also, I already mentioned about Kisan credit cards. On the urea supply side, they have announced a new plant with annual capacity of 12.7 lakh metric tons. So all these announcements will result into higher demand on the agrochemical side. On the fertilizer subsidy side, we are seeing that it is remaining kind of flattish, slightly down from the FY25 RE. But FY25 RE itself was much higher as compared to FY25B because the raw material prices were higher and the subsidy requirement was higher. And when we see a flattish subsidy next year, we actually expect that whatever are the losses or the requirement from the company side, government is willing to provide that subsidy. So that also is a positive from the companies, fertilizer companies side. When I look at pharma or the healthcare, there are about 36 life-saving drugs which are now in exempted list from the custom duties. There are 6 medicines which have got now lower duty at 5%, and there are multiple other patient assistance programs in the exempt list, which will result into more and more companies to import these drugs at a lower cost, and that should actually benefit majorly on the MNC side. There is also a focus on the medical tourism, which will effectively mean that higher patient footfalls in the hospitals, and that will also be a benefit for the hospital industry in India. That is basically positive on the pharma and healthcare side. Next, looking at some of the smaller things. So on the travel and tourism side, we saw that UDAN scheme is further modified to improve the connectivity to 120 new destinations. That will result in, again, better for the aviation related businesses. So all the airlines as well as your airport operators. Also, they have talked about developing 50 tourism cities in India. That will also boost your demand for hotels and in general travel. Some of the BCT reductions on copper and zinc scrap will benefit recyclers. Also, there was a push on nuclear power, which will benefit stainless steel players. These are the other smaller benefits which are coming out of from the budget. One negative. So when we look at overall budget, there wasn't any specific negative per se, but this was one thing which was coming on the LPG subsidy. So LPG subsidy has been revised only to 127 billion rupees, whereas your OMCs are already making losses to the tune of about 292 billion for the 9 month. And at current cost, they are still making further losses. So for the full year, this loss figure is expected to go up further. So that 127 billion looks a small number as compared to the losses which they are making. So that is a slight negative. But last year, out of the budget, they had announced a subsidy. So we expect something of that sort happens. Then that will again take care of this losses problem for OMCs. So those are other smaller announcements. But largely, when we look at this budget, as I said again, consumption was the main focus. So the consumption boost should definitely play out with your income tax slab changes and higher disposable income. And along with that, you have seen more focus on MSME side, agriculture side to improve the ease of doing business. There is less regulation now, better law, better structure on the custom duties that should revive the economic activity going ahead. And while doing all that, fiscal consolidation continues. So that is how we are looking at the budget from the equity perspective. Thank you.
Sudhir and Parag for sharing your insights and analysis of the budget. The webinar is now open for question and answers, and I invite the participants to keep sharing the questions in the link provided. While I wait for the questions to queue up, let me begin with the questions that we have already received. This question is both for Sudhir and Parag, both of you. What, according to you, are the hits and misses of the Union Budget FY26? Sudhir, we start from you.
So I'll say in terms of hits, for once, clearly the continued fiscal consolidation is what I'll say continues to be the biggest hit, and over delivering on those expectations. So I'll say that's the biggest hit in terms of the overall announcement. In terms of misses, I'll say, broadly, probably there could have been slightly more increased focus onto the capex front. The capex, if you look at growth, is assumed to be at a number which is lower than the previous year. Overall, there is a fall in the capex as a percentage of GDP to 3.1%, and even on the overall consolidated capex, if you look at it, has been slightly lower when compared to the last 5-year average as percentage of GDP. So I wish there could have been slightly bigger focus onto the capex front. So I think those are my observations.
Yeah, from the equity perspective, again, the main hit, as I said, the major surprise is on the income tax slab changes. So the boost to the consumption is, I would call, the major hit. And that is applicable, and that is basically beneficial for multiple sectors. And that has basically kind of as a single most important point of this budget from the equity perspective, as I would put it. Other hits, as I said, the deregulation, they have made changes to TCS or the TDS rules as well. So that has also resulting both from the individual side that there is a better, some kind of more cash flow coming in, resulting into higher disposable income. Again, from the company's perspective as well, your ease of doing business is going up. Uh, you are just basically now focusing more on your operations, and that definitely helps. Also, some of the duties are on the lower side, so that helps. That is again focusing more on the indigenous manufacturing. So overall, made in India, make in India, that push is still continuing. So that is another hit for me. On the misses side, nothing very specific. As Sudhir already mentioned, on some lower capex is kind of a miss. So some of the infrastructure related sectors will see a muted growth this year. But yeah, as there are some basic steps which has been taken on MSMEs and on the agriculture side, we expect that it should lead to economic revival, and that should kind of offset some of the impact of this lower capex growth expected. So more hits for sure and a slight miss is how I would put this budget to perspective.
Thank you. Very well said. Sudhir, my next question is to you. Can slower economic growth and a potential shortfall in tax collections, to 4.
Sorry, Sonal, your voice broke in the last. Can you please repeat?
I repeat that.
Yeah.
Can slower economic growth and a potential shortfall in tax collections, to the tune of 4.5 trillion from RBI dividend, capital gain tax, and STT in FY25, strain government finances, impacting capex and demand?
So I'll say quite valid question. Couple of things that, of course, the assumptions on the tax collection front, especially, so be it corporate tax and the personal income tax, especially taking into account the kind of, the tax benefits they have proposed in terms of nil tax up to 12 lakhs. So considering that or taking that into account at a time when economy is slowing, clearly put some risk to their, overall tax collection assumptions. But I'll say to counter that, one thing is there that, this kind of, as Parag also talked about, this kind of income tax benefit, which is effectively a clear, kind of giveaway to the consumers, and prompting them to consume more at some point. So, there are some upside, coming from that in terms of expectation of the or the revival of the economic growth, there is possibility of that. But let's say even if that doesn't happen, in that case also, I'll say government still has enough levers on the expenditure front. I'll say the assumptions on the expenditure side, if you look at the overall expenditure growth, they have assumed is higher, at least 1.5 to 2 percentage point higher when compared to the previous year. So, there can be some saving in case of, on the expenditure front, should there is a shortfall on the tax revenue front driven out of a slower growth. So I do not see that resulting into the overall fiscal slippage. But yes, it may, if at all the revenue growth is slow, then in that case, it may result into some bit of curtailment of the maybe the capex or the revex at some point going forward. Sonal, you are on mute.
Yeah. Sudhir, I'll continue with you for my next questions, talking about the budget assumptions. Up till, up until now, Finance Minister has been very conservative with the assumptions. But the fact that they are assuming an economy to grow in double-digit nominal and also expect 14 to 15% surge in tax collections, do you think that could be challenged looking at the global backdrop?
No, I agree. So as I have, talked about it in previous part also, I think that continues to be a challenge. Uh, the hope is, they have assumed closer to, 10.1% kind of GDP growth for this year, for the next year. I'll say the hope is that these kind of tax reduction they have done, that makes up for any reduction in the, overall tax collection. So my sense is, we still cannot assume that, there is going to be a clear cut, slip up on that front. So I'll say, we are still optimistic that, the overall GDP growth comes at say 10.5% on a nominal basis. So I mean, I'll not be too pessimistic on that front.
Sure. Parag, coming to you. Should one have a larger allocation to a particular sector right now? And if that is the case, should it be consumption because that is where there is a valuation comfort and delta play?
So, I mean, from the budget perspective, as I already mentioned, yes, anything related to consumption should see a better growth going ahead. Um, there are some smaller sectors as well which has got benefit, but the larger benefit or the most benefit will accrue to consumption companies. There are multiple sectors. So as I was explaining on the FMCG side, or the automobile side, or even on the consumer durables EMS side, we have seen multiple positives, not only because of this higher disposable income, but also along with that, some more specific regulations or specific duty structures as well. So those are the sectors which are benefiting in a big way. Even banking, NBFC, we are expecting that some kind of credit growth should be visible. So those are the sectors, as I would say, on the fundamental side should benefit more. In terms of final allocation, though, yes, the valuations will also play a major role in that. And on the valuation side, yes, some of the consumer companies or the consumer sector uh, parts, or I would say sub sectors, are at reasonable valuation. So those actually definitely can be looked at. But yeah, it's basically will definitely depend on how the valuations for those subsectors or individual companies are, and on that basis we can take a call. But that's a slightly different thing. On the fundamental side, in terms of next couple of years growth or in general sentiments being better, yes, consumer sectors or anything related to that, and maybe even something on the banking and industry side should be the ones which are majorly benefit.
Parag, diving a little deep in consumption,
Uh,
FMCG
so no, sorry, I
is
lost you in
price
between.
in. Let me just complete my question. Yeah. FMCG is price inelastic. So do you think market reaction on Saturday was a little exuberant? Would you suggest sticking with the premiumization theme?
So FMCG is, yes, I understand that it is price inelastic and basically for those smaller ticket items. But actually, we are not seeing that. I mean, what we are saying here is there is a higher disposable income in the hands of the consumer. So that way, it will basically lead to higher consumption. So your volume growth is basically what we are saying, not because the companies are reducing prices, because in general, the spending power of the users is going up. and that should lead to higher. So the price inelasticity actually doesn't factor in or doesn't play a role here. But having said that, that higher disposable income which is coming in should spur higher demand for consumer discretionary items more as compared to FMCG. So something like automobile or the consumer durables, large white goods are the sectors where we believe will have a higher impact or basically more benefit coming because of this higher disposable income. Uh, Again, there also it is not because those companies are going to take price cuts to drive the demand or drive the volumes more. It is just that there is higher disposable income in the hands of the users, which should lead to higher growth, higher volumes, and higher growth that way.
Thank you, Parag. Sudhir, coming to you. If private and household capex doesn't offset lower government capex, will there be sufficient job creation with not having as much of a capex outlay? Was the move of income tax a right tool to give fillip to consumption economy or slow down in the economy?
So I'll say broadly, if you look at, I'll say while in terms of percentage of GDP, there was slightly higher expectation on the capex front. So compared to, for example, last year, the budgeted number was at 3.4% of GDP. It turned out to be 3.1. And this year also, for the next year also, they are projected at 3.1. So while I'll say the overall expectations were high, given the fact that, over last, say, 4, 5 years, we have seen a significant growth in the capex number. But broadly, if you look at the absolute amount of capex, still continues to be meaningfully high. So, over a large base of last, say, 3, 4 year, a further capex growth of 10% plus year on year, I'll say that's not a very small number. So in terms of giving a flip to the economy, I'll say this kind of a capex from a medium term perspective continues to create overall good environment for creating more jobs going forward. My sense is government has given slightly higher priority on the consumption theme this year, probably because of the near-term slowdown on the growth. So my sense is while meaningfully almost doubling of the capex over last 4, 5 years is something which is creating decent environment for the overall job creation at a time when the private capex is not picking up. But my sense is at this point, a move to provide a consumption boost, especially to the urban middle class, where we have seen some initial sign of stress. I'll say is very well timed in our opinion, and my sense it should not overall spoil the medium term job creation target of the government. At the same time, the near term sentiments which have turned negative, I think it should consumption boost for the urban consumer. I think that is something which should overturn the overall bearish sentiment of late in last, say, couple of months or quarters. So I'll say broadly, the budget looks balanced to me in that sense.
Sure, Sudhir. Our next question is again to you. Historically, trends suggest that putting money in consumers' hands can lead to inflationary pressures with a slight lag, but yes. RBI has already been dealing with high inflation post-COVID. And now that inflation is controlled to a larger extent, do you think inflation can again go up from here?
My sense is this is a bit too early to comment on that, considering that, if you look at the overall early trends on the inflation, it's scheduled to move, or it's expected to move towards the RBI's medium-term target of 4%. So I think over this month or next month, we should see it heading towards 4%. So at such time when the inflation is well behaved, and at a time when there are some, shocks to the growth, especially from those, global factors such as the tariffs and all. My sense is this kind of a consumption boost may not be too inflationary at the moment. So, I don't think it should have a material impact on the inflation going forward at this point of time where growth inflation scenario is unfolding in a manner where inflation is moving towards target and growth is slowing down, and hence a kind of a consumption boost was very well required at this point.
Sure. Parag, coming to you, within autos, which particular theme that you would pick up? Would you say that it is going to be two-wheelers versus passenger wheeler vehicles? Any segment or you think will do particularly well?
Um, so within autos, if you see, again, the main theme is higher disposable income. The higher benefit which we are actually seeing is, income group of maybe that 5-7 lakhs annual to 24 lakhs kind of. There you are seeing the highest benefit of this income tax slab changes. Um, Now that is a group where I believe four-wheeler consumption might be slightly more. So if there you are seeing a increased disposable income, then the four-wheelers might be benefited a little more. Uh, but at the same time, and there was focus on agriculture, MSMEs, so on the rural side. Again, two-wheelers will also benefit for sure because of those other changes. Uh, but just that relatively uh, four-wheeler is more discretionary as compared to two-wheelers. Penetration is lower on the four-wheeler side as compared to two-wheelers. So this higher consumption thought process is it will lead and it will have higher impact, higher benefit for more discretionary. So from that angle, four-wheeler might be slightly more benefited. Also, there are specific regulations on the EV side, as well as on the lithium ion battery and the scrap custom duties being lower there. So even within automobile space related to EV manufacturing or on the recycling battery side, you should see some plays there as well. So something which is actually a combination of maybe four-wheeler as well as EV might actually benefit the most. But yeah, so four-wheelers, EVs slightly better as compared to two-wheelers is how I would put it.
Sure. Parag, next question is again to you. What, in your view, the budget will have any impact on the bank's credit growth, and how will it impact energy sector?
Right. So specifically taking up on the banks, so as I mentioned in the presentation, there are few specific announcements on the credit growth. So both on the MSME side as well as on the agriculture side. Also, there were announcements on the housing and urban infra. So all those will lead to better credit growth. As I already mentioned, some specific announcements on the agriculture side. You had Kisan credit cards on the MSME side. You had again another credit cards for MSMEs as well as guaranteed credit that limit being increased. So those should actually result into higher credit growth. So that way, in those pockets, in those buckets, I expect that your credit growth should be higher. That should benefit your bankings and NBFCs more from the MSME and the agriculture side. But overall, the system should see better credit growth. In terms of energy, there weren't any specific announcements on overall energy basket per se. The one thing which stood out though was on the nuclear side. So just comparing with the previous budget there were many more announcements on clean energy. This time we have seen announcement only on the nuclear side, with giving a 100 gigawatt target for 2047. But yeah, I mean, with that focus, I expect some more push on the nuclear side. So nuclear is one of the most clean source of energy, but we haven't seen much pickup on the nuclear energy side in India, with this budget specifically stating or doing some announcement on the nuclear energy. We believe on that side of the energy, you should see some better demand or better benefits flowing through. But apart from that, there wasn't any very specific or material benefits on the overall energy basket.
Sure. In the interest of time, I will take two more questions. Parag, this question is to you. It is commonly said things which were on the back seat come to the front seat, and what is in the front seat goes back to the back seat. The budget was pretty much a contrast of 2021 budget, when we pivoted the other way around, and that in a sense it was called that that 2021 budget was called Capex ka Mahakumbh. Is this consumption ki Diwali? The difference is that the expenditure cycle was a very long one. This consumption cycle may be just a short one because the economy has to do well for it to do well. What are your views?
So I answer in two parts. So first part on the change of the stance. So yes, that is definitely there. For last 4 5 years, we actually, as I said, haven't seen anything specifically on the consumption side or specific steps to boost consumption. Uh, Government was definitely doing some small steps, which would have ultimately led to higher consumption. But what they have done in this budget by increasing or changing the tax slabs and increasing the on disposable income, that kind of boost we hadn't seen for 4 5. And at the same time, we have also seen some lower capex. I mean, they are also doing a balancing act of managing the fiscal consolidation at the same time. So that we are seeing some lower capex. So some change of stance for sure. But I wouldn't say it's a complete U-turn. You are still taking steps on some parts of the capex. So maybe your railways or the road capex is flat, but defense and other some of the missions are still seeing good growth. So that way, capex is still continuing. And government definitely can relook at and next year or maybe a couple of years down the line again push the button on the government capex. So that can definitely happen. So that way, I wouldn't call this as a complete U-turn from the earlier stance. And the boost on the consumption is definitely required. Right? So that way, it was anyways needed. So good budget from that stance. Whether the consumption cycle will be short or the long, and we'll have to see. We're already seeing some kind of slowdown in consumption. So on back of that, we were expecting a consumption revival. Along with that, now with this boost, should go actually a long way, and we might expect a slightly longer term cycle as well. But we'll have to see how exactly it pans out because yes, overall economy also has to revive for the consumption to go up. That job creation and that basically higher income will lead to more consumption for sure. But this, as I said, maybe in the near term can boost, and then the other steps on the economy side can then further take this for a longer consumption cycle. That is the hope. That is how I would look at it.
Thank you, Parag. Sudhir, last question for today is for you. Announcements that we have heard from the government in the union budget, we have monetary policy lined up for us next week. What do you make of the action that is expected in the coming monetary policy? Do you expect any rate cuts to be announced when the policy is discussed?
Yeah, so yes, considering that the budget was quite responsible in terms of the fiscal consolidation, meeting all its promises, what they have made in the last budget, and rather over-delivered on that front. And at a time when inflation is expected to align to its medium-term trajectory over next, say, 1 2 month, and growth slowing, we do expect it gives all the more reasons to RBI to deliver a rate cut in the policy this week. And at the same time, we do think that at a time when there are so much of global uncertainties in terms of new administration in US and the subsequent tariff policies and the changes on the fiscal front, the tax cuts and all. My sense is the scope is still limited. So with the expectation of 25 basis point rate cut in the coming policy this week, we expect this will be the beginning of a rate cut cycle in India, but that will be a shallow one with collectively 50 to 75 basis point of rate cut expected over next a couple of months and quarters.
Thank you. Thank you all for being part of today's webinar on the update on Union Budget for FY26. We hope you found the webinar engaging and insightful. Please share your feedback on the link provided. Special thanks to our speakers, Sudhir and Parag, for their valuable insights. Thank you. Good day.
Thank you, Sonal, and thank you everyone for participating in the call.
And thank you, Sonal. Thank you, everyone.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Recording stopped.